Okay, I think we're just ready to get started right now. So welcome again, and thank you for joining our webinar presenting the 2016 Sales Rep Salary Survey results. My name is Oren Ezra from Peppery, and I will be your host for today's webinar. Just a few housekeeping matters before we get started. You're all in listen-only mode, and if you have any questions that you'd like us to address, please type them into the questions box in the GoToWebinar panel on the bottom right, and we'll do our best to answer them in the Q&A session at the end of our webinar. We are very excited and honored to host David Fritz, moving on to the next slide, President of Growth Solutions, on our webinar today. David has a wealth of experience in the field of sales rep incentive programs, covering the design and measurement of incentive plans. David has impacted the payout of more than 100,000 sales reps in his 27-year career, having worked with hundreds of organizations, large and small, in various consumer goods industries. David will present the results of the survey and discuss their implications on the industry and for you guys on the other line of this webinar. So just with this background behind us, I'd like to spend a few moments explaining the methodology with which we came up with the salary. So our salary respondents were sent an invitation online to participate in our survey via email, social media. We gathered responses across a period of 3 months during July to September of this year. The survey results were filled out online, and all respondents will receive the survey results right after this webinar within the next 5 to 7 days. Just a word about the responses. We did take out of the survey results all answers from sales reps from non-packaged goods industries. So for example, vehicles, IT software, these types of results were removed since we are primarily concerned with a salary survey of consumer goods, packaged industries. So with this in mind, I would like to turn it over to David, who will present the survey results and their implications. David?
Great. Thank you very much, Oren. And can you hear me okay?
I can hear you great.
Fantastic. So the first thing I would like to talk about is why do we need to even benchmark pay levels and pay practices? And there's really two fundamental reasons why an organization would want to look at some of the results that we're going to share with you today. And the first and perhaps most obvious is to understand what the market rate of pay is. And really, there's two ways to define the market. One way of defining the market, which I don't think is necessarily the best way to define the market, is to look at just those companies who you sell against. We'll call that the product market. That is, we want to understand how other people are paid that sell a very similar product portfolio. So that's one way you can do it. A second way you can look at defining the market is a little bit more comprehensive, and I think a better way to define it, and that is to look at the entire labor market in which you compete for talent. That is, where do you hire from, and just as importantly, if you're unfortunate and you lose some talent to others, where do they go? What industries, what type of companies? So when we look at benchmarking, first and foremost, we want to understand what the market rate of pay is, because if we're not competitive, it's going to be difficult to attract and retain the right talent. And ultimately, that leads into the second reason for why we do these surveys, is we want to make sure we can develop an appropriate compensation package, an all-in compensation package, the right mix of base salary and total compensation, and the right incentive mechanics or levers that will ensure that we can continually attract the right talent as well as retain those top performers. So with that, understanding why we do these, let's talk a little bit about who is actually in the survey. Because at the end of the day, we want to make sure we have a reasonable and appropriate benchmark to compare ourselves to. So as Oren mentioned, there were some surveys that were removed that we didn't think fit the packaged goods industry. And after removing those respondents, we ended up with about 650 total respondents to the survey. Just some quick demographics as it relates to gender. We had a 77 to 23 split between male and female respondents. So the predominant portion of the survey respondents were male. We also had a very strong bias as related to geography. We had 62% of total participants residing within North America, and within that, the vast majority are within the U.S. We also had a significant portion of participants from EMEA at 34%, and then we had a very low participation rate or number of participants from the rest of the world and Latin America. So as we look at the balance of slides and some of the data we're going to share with you today, I want to emphasize that the vast majority of data you see is going to be influenced very heavily by North America compensation levels. And I believe when a participant report is issued, sometime perhaps in the next week or two, there will hopefully be some breakouts that look at compensation specifically, North America versus EMEA, because there may be some important differentiators. The next important demographics was age and company size. From an age perspective, we have actually a very good mix of folks who are relatively early in their career. Between the ages of 25 to 34, we have 23% of total survey respondents. The largest portion of survey respondents were those who I would consider mid-career, 35 to 50. And then finally, we also have a good sampling of folks who are at perhaps the later stages of their career, ages 51 to 70. In terms of company size and the number of employees that the participants work for, the good news is we have a very broad mix. It's not overly biased towards large or small companies. By the way, the 24% that's shown in this area of the graphic, hopefully you can see that a little bit better now, into this area of the graphic here, represents folks who did not provide the size of their company, and so we can kind of ignore that piece. You can generally see as we go around this pinwheel is that we had about 10% of the companies would be very large at 500 or more, 6% at 200 to 500, also fairly large, and then 8% at 100 to 200, et cetera, all the way to the largest single segment, which is 17% at 10 employees or less. In terms of the years of sales experience, that followed the age demographic fairly well, with a large percentage of the people having significant experience, sales experience. We had 24% with 25 years or more, another 26 with 15 to 25, 23 with 8 to 15, and 18% with 3 to 7, and relatively few participants with less than 3. So again, you see we have a fairly tenured employee population within this survey. The next demographic has to do with title or function or position within the organization. And we'll start from this kind of noon within the pinwheel and go around it counterclockwise. The largest percent of participants were classified themselves as field sales reps, Interestingly enough, the second largest number of participants classify themselves as the CEO or owner of their company. So obviously we have probably a fairly small company bias in that particular job role. We had another 12% of participants who identified as VP of sales or head of sales, 9% as a sales team manager, 8 as inside sales rep, and 7 as sales director. Some of these other jobs, beginning with the 4% in business development and through marketing manager and HR, as it relates to the survey results we're going to share you, we've actually pulled those positions out from some of the other slides simply because there's not a lot of participation. Finally, as it relates to demographics, we also took a look at what kind of sub-industries we have within packaged goods. And think of this chart as a way of looking at what people sell, not necessarily who we sell to. And the largest group within that was industrial manufacturing, home and gifts, food, apparel and fashion, consumer electronics, and then it gets a little bit smaller in terms of but overall, we feel pretty good about the survey because getting back to that chart I had on why benchmark is we believe that it's most important to look at the competitive labor market, not just simply what companies are competing with you from a product perspective. So I think some of the results that you'll see here are representative of a broad-based view of the labor market and not specific to one product classification. So with that, let's go into some of the actual survey results. Some of the statistics that we're reporting on when we share with you the survey results have to do with averages, and I think that's a pretty straightforward statistic we're all familiar with. Some of you may be less familiar with percentiles. So what we will do is we will report to you on a couple different percentiles. The two that we're going to focus on today is the 50th percentile. And basically the 50th percentile, or also known as the median of a distribution, represents the point at which 50% of the participants are below and 50% of the participants are above. It oftentimes is close to the average, but as it relates to compensation benchmark, it's usually considered a better statistic than the average. Because if you have a distribution with several very high earners or several very low earners, the average can be impacted. Whereas if you have that same distribution and you look at the median or 50th percentile, that tends to be a little bit more stable of a statistic. We're also going to share with you some data as it relates to the 90th percentile, and that's the part of the distribution where 90% are below a particular value and 10% are above. So when we share with you the 90th percentile salary or the 90th percentile total cash, that means that's where the top 10% of people earn. That's where they begin to earn. Some other things I want to define before we move on is some terms. So the first term is base salary. So when you hear base salary today, it's going to refer to the fixed or guaranteed compensation paid on a regular basis, typically anywhere from weekly to monthly. Base salary is commonly reviewed on an annual basis and may be increased based upon merit or cost of living. Total cash compensation is equal to base salary plus any variable performance-based pay. That could be incentive, commission, bonus, or whatever your organization might call it. Total cash compensation typically excludes benefits, perks like cars, and equity if your company happens to offer that. The final important term for today is compensation mix. This is essentially a ratio, And compensation mix refers to the portion of total cash compensation that is made up of salary versus variable performance-based pay. For example, if you had a position that was paid a salary of $60,000 plus they earned a bonus of $40,000 or a total of $100,000 in total cash comp, we would call that a mix of 60-40. 60% of the compensation being fixed coming through base salary, 40% being variable or at risk coming through some sort of commission or bonus. Now that we understand some of those basic statistics and terms, let's talk about what we've learned. This first chart, I think, is probably a fairly obvious one, and that is geography matters. So whenever you're looking to benchmark pay, it's absolutely critical that you zone in on the right geography because labor markets are local. So what we've done here is we've taken all the survey participants, regardless of role, and we just looked at what their average cash compensation was across all positions. Not surprisingly, North America has the highest level of average pay at just above $100,000. Latin America and APAC, which is common, will tend to lag behind North America. And finally, with EMEA, we actually think this is a little bit of a sample bias. EMEA data would typically be a little bit more on par with North America, but as you recall, we had a little bit lower percent of participants from that region, and that's why I think we're showing that a little bit lower across the board. So these particular dollar values, and by the way, everything here and throughout the presentation is indexed in US dollars. This particular chart is not particularly prescriptive or instructive. It's just really a way to emphasize that when you do the benchmarking, it's important to look at the geography that's appropriate for your jobs. Oops, I missed a slide here. Let's see here. We actually had a slide that for some reason seems to have been deleted from our position, and that was a slide that had to do with the distinction between male and female compensation. And let me just kind of walk you through or talk you through the results of that. And by the way, for those of you on the call who are in the US, you know that pay equity between male and female employees is a very hot topic at this time. What we found in the survey, and again, we had substantially more male participants than female participants, is we found that, interestingly enough, base salary was almost identical between male and female participants. In fact, across all jobs, female participants reported slightly higher base salary than male participants. On the flip side, as related to total cash compensation, we found that male participants reported approximately 10 to 15% higher total cash compensation than female. And so we started to say, well, gee, do we have gender pay inequity? And what we'd like to do is we'd like to kind of take you through some more detailed data. That is, wait a minute, don't jump to any conclusions, and let's try to understand what's behind the data. So the first thing we found is we found that position does matter. Okay? And what we see here is that depending on your position within an organization, you can expect a very different base salary and total compensation level. Again, very obvious, very intuitive. Let me kind of take you through this chart and make sure that we all understand what these statistics mean. I'm going to highlight the CEO and owner bar. This green bar here suggests that the average CEO or owner reporting within our survey had a salary of just under $80,000 US. Their total cash compensation, on the other hand, was just under $120,000 US. By the way, the relationship between those things, the base salary and total cash compensation, what we found is that about 65% of the typical CEO or owner's pay came through fixed compensation or base salary, and then the balance, approximately 35%, would come through variable or performance-based pay. So that's how to kind of read these bars. Green is salary, blue is total cash compensation. The line above refers to the axis here on the right, which is what percentage of their pay is guaranteed or fixed pay. So again, we have the CEO owner at around 65% with a average salary just under 80 and average total cash of just under 120. So the first thing you'll note about this chart as we go to the right is that there's a position that's actually paid more than the CEO and owner. That is counterintuitive. That position is VP of sales or head of sales. And we think the reason for this, again, is a function of who participated, with most of the CEOs and owners representing smaller companies, whereas most of the VP of sales, head of sales, were participants within larger companies. Generally speaking, all other things being equal, larger companies can usually justify and afford a higher rate of compensation. So very interesting finding that CEOs and owners are actually paid lower than VPs of sales or heads of sales. I also think it equates to what the total reward package is for CEOs and owners. It tends to be more equity-based, and the way they ultimately earn compensation is to increase the value of their firm, which results in a higher equity value, and that is the primary way of creating wealth. So as we go through this, we see that the head of sales is typically, on average, making just over $80,000 in base and closer to $140,000 in total cash comp. So again, they have a fairly aggressive mix, with close to 60 to 65% being fixed, the rest being variable. As we move to the sales director position, the compensation levels go down for both base salary and total cash. But the mix is also, still aggressive. In fact, the fixed component drops a little bit to about 60%. As we move to the next level of sales management, the sales team manager, the base salary and cash compensation on average drop again. And interestingly enough, the mix goes slightly up, where the mix now is closer to about 68% of pay coming through fixed versus variable. The mix gets more aggressive as we go to the field sales rep position. And again, the continued trend of compensation, not surprisingly, both salary and total going down. And then finally, the last position, inside sales rep, interestingly enough, they would have the most of their pay at risk based upon performance, with only about 45% of their pay being fixed and about 55% being variable based upon performance. So position matters, and getting back to that question of female versus male pay, and do we really have pay inequity? One of the things we look at is, based upon our survey, what positions do the female respondents occupy? And you can see it's actually pretty close to the positions that the male participants occupy, with a couple exceptions. There's actually more females who reported themselves as CEOs and owners than males. That's a good thing and an interesting thing. We also have slightly more that are sales team managers and sales directors. and females tend to lag men a little bit in the VP of sales role and in the field sales rep role. So by and large, there's not a huge bias in terms of what positions men have versus women, but the key one being perhaps in that CEO position. So one of the things we started to look at then is we looked at, well, what is the base salary by role and gender? And again, I said overall, females reported a equal to slightly better base salary than men. What's interesting is that we have more women than men in actually the CEO owner role, but look at this disparity in base salary between men and women. Women are essentially earning or paying themselves a base salary of about $60K within the survey participants, whereas men are just over $80K. So there's more women in the CEO position / owner position, and I think many of that is in actually an owner position than men, and they're also paying themselves less. Why is that? Your guess is as good as mine. I suspect that it has to do with a more conservative nature in terms of women wanting to build the business and invest in the business and ultimately create value through enhanced equity. But one would think at the CEO and owner position there's more discretion over how much cash compensation is being paid out than there is in other positions. Interestingly enough, women are actually out earning men from a base salary perspective in 2 of the executive sales positions, the VP of sales and the sales director. A little bit less in sales manager, a little bit more in field sales, and a little bit more in inside sales rep. And ultimately, we want to also look at whether there's a gender bias as it relates to total cash compensation, because salary is just a component. So here again, you see the conservative nature of how women CEOs or owners pay themselves, and it's considerably less than their male counterparts. The total cash compensation at the executive sales positions, the VP of sales and sales director, women are equal to, just a little bit more highly compensated than men. That trend reverses as it relates to the sales team manager, reverses again as it relates to field sales rep, and reverses yet another time for inside sales rep. So I think one of the things that's kind of communicating to us is there does not appear to be a systemic pay inequity between men and women in the survey, but it is very much job dependent. The other thing that really matters is experience. So we mentioned before that geography matters a lot when using benchmark data. We also said that position matters a considerable amount as it relates to looking at compensation data. The third thing that you have to factor in when you do benchmarking is the experience level. As this chart demonstrates, there's a very clear correlation between one's experience, and this is total experience, and their base salary as well as total compensation. From the beginning employee, less than 1 year in sales, to 10+ years of experience, base salary can be expected to increase by 59%, whereas total cash compensation actually increases by 85%. And again, this is kind of cut across all functions, but we'll see that within each of the functions as well. Some other things that we saw that may or may not factor into how you want to benchmark your jobs is the size of the company. It matters a little bit, but maybe not to such a huge degree. So when we look at total cash compensation, again, this is across all positions, by size of company, we see some increase in total cash compensation as you go from very small to kind of mid-size. And then generally speaking, it kind of levels off above that. So unless you're kind of in a startup mode or a very small organization, we'd actually suggest to you that benchmarking companies of like size is not as critical as benchmarking companies in the same geography, benchmarking the same function or position, and benchmarking experience levels. Those other three factors, we believe, are more critical than size of company. This next chart talks about, what is the right base salary level? So here we've not really focused in on geography. We haven't really focused in on experience level. We've really focused in on the position title. And what we're showing here on this particular graph is we're showing two statistics. We're showing the average, which is in green, and the 50th percentile, or the median, of the reported values in the blue. Generally speaking, what you want to do is when you benchmark your jobs, rather than looking at average salary, we would prefer you look at median or 50th percentile salary. It tends to be a more stable statistic. And what you'll generally notice is that the two statistics are somewhat close for all of these positions, but the average tends to be a little bit higher than the median. And that's true with the CEO and owner, the sales director, the sales team manager, the field sales rep, as well as the inside sales rep. So again, if you're given the choice between one statistic, you'll tend to want to focus on the 50th percentile or median as opposed to the average. The other thing to note about this chart is you'll see that same kind of trend as we saw previously, as the executive level sales positions earning higher levels of base salary, and it being reduced a little bit as you go to the next level down, with the lowest compensated position within the sales hierarchy being the inside sales rep. Another rule about attraction is to not only, in fact, let me go back to this slide real quickly on the prior page, is to make sure that we have a competitive compensation package. Again, compensation consists of base salary plus the variable. That equals the total. We want to pay competitively on base, but you don't want to pay too competitively on base. So a good rule of thumb is that you want to benchmark your base salary to the market's 50th percentile. That will ensure that you're meeting kind of the fixed financial obligations of the participants within the job, and that you're reasonably competitive with the market as a whole, but you're not overpaying as it relates to fixed compensation. When it comes to total cash compensation, there's a different rule. We no longer want to see organizations simply pay at the 50th percentile. What we'd like to do to ensure that you can attract and retain the right people is we'd like to see you have total compensation for your top performers equate to the market's 90th percentile for total cash compensation. So again, on this chart, we have two statistics. We're showing the average total cash compensation by position and then the 90th percentile. So let's go right here to the field sales rep as an illustration. On average within the survey, a typical field sales rep looks like they're making around $65,000, maybe $70,000 a year. What we'd like to see is the very best salespeople within your organizations making what the very best make within the industry. And that would put you at a total cash compensation level closer to maybe $110,000 or $120,000. So you can see that there's substantial variance between 90th percentile and the average, and we want that. Again, assuming that those people are also your top performers. One of the problems with compensation design is sometimes we benchmark and focus too much on the 50th percentile for both base salary and total cash comp, and we forget that our top performers are the most marketable, and those are the ones that we have to be most concerned about are earning at the highest levels of the competitive labor market range. So let's move away from some of the kind of hard data. And again, you'll be getting copies of that hard data through the participant report. And let's focus more on some compensation practices. So this next chart looks at 3 significant compensation practices within the survey. The first had to do with how frequently is variable or bonus or commission pay delivered. You know, the good news is the most frequent amount, which is close to 60%, was delivered monthly. And that makes total sense, because if you recall from that earlier chart on compensation mix, typically the compensation mix is 60-40, which means 60% of people's pay is coming through fixed, 40 variable. Well, when you have that much pay at risk, it's really important so you don't create cash flow problems for your salespeople to pay out more frequently. And so that's why we're seeing 60% of the survey pays out monthly. A little bit surprisingly to me is that 27% almost pay out on just an annual basis. I suspect that that has a bias towards some of those higher level positions, VP of sales or owner and CEO, which tend to have a little bit less frequent payout. And then we have a small minority of participants who are paid on a quarterly basis. Generally speaking, best practice is to pay as frequently as you can and as close to the sales event as possible. So we like the monthly. Another practices question had to do with whether there was a cap on the bonuses. And what we found is that 75% of the participants did not have a cap on the amount of bonus or variable pay that they could earn, which is great. Unfortunately, 25% did. We also started to do some analysis that says, well, does the cap really kind of matter? Well, it really does to a degree. So if you have no cap, we found that the average participant earned roughly around $95,000. However, if you were unfortunate enough to have a plan that was capped, that average participant earned about 6% less, around $88,000. So although this is not necessarily cause and effect, I think there's clearly a correlation that says caps tend to reduce compensation. No surprise there. We also took a look at whether or not the cap had an influence on how much new business was written with new customers each year. And interestingly enough, we did find a little bit of a correlation. We don't have a chart on it here, but I'll just speak to it. And we found that you're about 50% more likely to have a low percent of business coming from new customers if you have a cap than if you don't have a cap. So again, kind of interesting finding. What I'd like to do to wrap up our discussion on pay benchmarking today is just to talk about some of the unintended consequences of compensation programs, particularly as they relate to salespeople. And I think there's 4 key ones, and some of this benchmarking data can help us avoid these 4 consequences. The 4 have to do with, first and foremost, reps shutting down. That is, if you have quotas that are too high, thresholds that are too high, or, as we just spoke about, a cap in your incentive program, you can have the unintended consequence of a rep not driving sales 24/7, 365 days a year. So we tend to want to avoid anything within our incentive plan that would in any way encourage a rep to shut down during the year. Another Unintended consequences, reps selling a poor product mix. The third is reps not hunting. And again, I shared with you some data as it related to this survey, and that there seems to be a correlation between having a cap in the plan as well as not having accelerators within the plan, which was another practice that will be reported out in your survey report. If you have a cap and you don't have accelerators, you're more likely to report less new customer acquisition results, which is bad, obviously, for the long-term viability of any company. And ultimately, if we don't benchmark and we don't position our compensation appropriately, you're much more likely to experience rep turnover. So again, those are the 4 key consequences, if you will, of poor compensation program design. Again, benchmarking is a key input to help you avoid at least 3 of those 4 consequences. The final thing I want to leave you with before we talk about some questions would be around the different design decisions you need to make when you determine how you want to pay your salespeople. Beyond figuring out what their compensation levels should be, using some of this benchmarking data that will be shared with you, another key variable is compensation mix. Again, that's the ratio between salary and total cash and incentive or variable pay and total cash. You need to make a decision about what should the mix be, how much pay should be at risk based upon performance. If you go with a 75-25 and the market pays at 60-40, you might be good at attracting people who are interested in fixed compensation, but you may be missing out on some of the best, most aggressive salespeople. Conversely, if you have a pay mix that's at 25-75, where very little pay comes through base salary and most of it is variable based upon performance, you might be missing an opportunity to attract some very good people simply because the guaranteed monthly cash flow. That'd be particularly true if you have a relationship business or a long sales cycle business where it sometimes can take years to build up sales performance. The second important variable or design decision you'll have to make is what are what are your incentive or performance measures going to be? Generally speaking, you want to have as few performance measures as possible so that the variable pay does not become diluted. And ultimately, the right measure for you is a direct function of what your sales strategy is. Is it about revenue growth, profit growth, be it price realization or product mix? Is it about driving specific products, et cetera, et cetera? Again, the key here is to be very selective. So we have no more than 3 performance measures, ideally just 1. The third critical decision you'll need to make as relates to designing your compensation program is what type of plan. There's fundamentally 3 types of plans. There's commission programs, also known as cents on the dollars or percent of sales plans, where you get an absolute payout depending on what you sell. 10% of sales, $10 per unit, however you might describe it. A bonus program works very different. It's a relative payout, not absolute, and there's usually some sort of goal or budget number involved there. So you get X bonus dollars when you get to 50% of goal, and more when you get to 75% of goal, and more when you get to 100, etc. And then finally, there's combination plans or hybrid plans that include components of both. Another important design decision you'll need to make is payout curve. And what we mean by that is how is incentive earned throughout the performance spectrum? And that is, will you have a threshold or will you pay from $1? If you do have a threshold, what incentive will be paid at threshold? What will the breakpoints be? How close to getting to quota will accelerate the pay? And finally, will you use caps or not? As you see, we're not big fans of caps. Sometimes they're essential and needed, but they tend to create unintended consequence, as we saw on the previous slide. And they tend to diminish new customer acquisition activity, as we saw on a couple previous slides. And then finally, the payout frequency. Our belief is more often is better. And if you can afford and have the tracking to do it monthly, that would certainly be a strong preference. There are other cases where quarterly or annual can be more appropriate, but as a general rule, monthly is better. So with that, Warren, that's the end of our formal presentation. Perhaps we can open it up to questions from the audience.
Absolutely. Thank you very much, David. We will now open the floor for questions. So as a reminder, if you have any questions, please type those in the box, the questions box on the right-hand side of your GoToWebinar window. And to start with, David, we have a few questions. First, I think it's more of a housekeeping. Many attendees asking whether they will receive a link to the recorded webinar. Absolutely. We will be sending the recorded audio and video in a link tomorrow. So you should receive that tomorrow a.m. The next question, David, for you. Do you have any data about total compensation for independent sales reps, those with 100% variable? With the following question, are these comparable to employed reps, those that do have a base salary?
Very good set of questions. Let me answer the second one first. For independent reps, you will tend to see an elevated level of compensation than you would for company employed reps. And the reason for that is pretty straightforward. Is one, the independent rep has to pay for their own benefits and selling expenses to a large degree, if not exclusively. And so there needs to be higher levels of compensation to support those additional expenditures. Number two, the independent reps essentially have 100% of their pay at risk based upon performance. If you don't sell, you don't earn any cash compensation. And as a general rule is, the more pay at risk, the greater the upside. And so what you'll tend to find is that because of that risk return, independent reps also have typically a tremendous opportunity to earn above what their employed counterparts can earn. And I believe, Warren, the survey data, I don't know if the sample size will support this, but I believe, and this answers the first question, is I believe we can cut the data that we received by independent rep versus company employed rep.
Absolutely.
And that will give you the specific differential that I'm speaking about. And I would strongly expect that the independent pay will be higher than the company employed pay. And you can tell me in a few days if I'm right.
Yeah, absolutely, David. And we do have that information. It will be covered in the written report, in the soft copy that we'll be sending out. And so, yeah, absolutely be on the lookout for that measurement if you are employing independent sales reps. The next question regarding average commission paid in the US. Do you have any breakout by industry? So, David, I guess, what is the average commission rate paid in the US? Do you have any sense for that?
Yeah, that's a great question, and so much of that is specific to the product set that you're selling, because every product will have a different underlying gross margin, and obviously commission rates will have a very strong correlation to the product's underlying gross margin percent. So if I'm receiving a commission on revenue and I'm selling a product with an 80% margin, you know, I could be earning 10+% of revenue on that particular product, because it's really, as a percentage of GP, not such a big deal. Conversely, if I'm selling a product set that has 20% margin, there's no way I'm going to receive a 10% commission rate because that would be 50% of the overall margin. And so your commission rates would start to dramatically reduce. So I would think of it as really more of a formula, if you will, and you take a look at gross margin percent, and as gross margins percent declines, so does the commission rate if it's expressed as a percent of revenue, which most are still commonly expressed as a percentage of revenue, but not exclusively. A lot of organizations have decided to solve for that and simply pay as a percent of gross margin dollars, presuming they're willing to share their cost data with the sales force. Hopefully that helped.
Yeah, David, and I will add that we do have data by industry, so base salary and total compensation by industry, of which home and gift is one of the industries that we did capture. We will be publishing that as part of the report as well. I guess we have time for one more question. Salary, commission, bonus for a new sales rep in a newly created sales position for the company. Do you recommend a straight salary with no commission bonus ever?
Yeah, that's a great question. I am such a strong believer in pay for performance and the use of variable pay that even for brand new positions where it's unclear what the path to success is going to be or what even success looks like, I still have a bias towards having at least some portion of the pay variable. Now, we may not go to a 50-50 compensation mix for that kind of position, but what we might do is we might go to 90-10 or 80-20 just to make sure that we're getting people used to the concept of variable pay. And instead of having the variable component based upon revenue, which we may not be able to project what a reasonable sales performance would be, we might make the sales performance in the short run, maybe for the first couple quarters or maybe even as much as a year, depending on how long the sales cycle is, we might make the performance measures more MBO-based, strategic objectives, milestone-based, which can be a little bit more concrete. And then as you start to gain success with that position, you migrate the mix maybe from 80-20 to more 60-40 over time, and you migrate away from milestones or MBOs as the objectives to actually putting in sales quotas.
Great. David, I wanted to thank you very, very much. We don't have time for more questions. However, I did want to emphasize that we will be sending out the detailed full report of the salary survey to everybody that registered for the webinar. So in addition to the recording of this webinar, which we shall send tomorrow, we will also send the full detailed report, which has much more data broken down by industry within a couple of weeks' time to everybody that registered. So with that, I'd like to close and wrap up this session. David, thank you very much once again. Ladies and gentlemen, thank you for joining us, and we'll be in touch very, very soon.